My futures trading story started 15 years ago when I was 19 years old. I was working on Wall Street as a market strategist during the day for a spot foreign currency broker-dealer while attending business school at night. I was helping retail and institutional clients navigate the currency markets, and I found that the only way to do so was to trade myself. So I started trading currencies. However, at this time during the 2008 financial crisis, the only news blasting on CNBC and Bloomberg at the time was the stock market. And as a currency trader, I was actively day trading. But in my equities account, I didn't have $25,000, so I couldn't day trade stocks. I was only able to actively trade S&P equity futures at the time. So futures became the product that allowed me to trade what was moving at the time without any restrictions. And it was during these 2 years of trading futures that I developed my trading strategy and learned that discipline is more important to my success as a trader, something that I carry to this day trading stocks, options, and currencies. Technical analysis is simply the study of charts or price action and its history to forecast what is likely to happen in the future. It is based on the idea that while markets may not repeat itself, it rhymes and has repeating patterns that can be identified. Some challenges with technical analysis is that there are an infinite number of ways to read a chart and filters that you can add to identify those patterns, which makes it so vast and seemingly complex for beginners. My advice for beginners is to dive right in, but keep things simple. Learn how to read price first. It's the only leading indicator. All others are lagging and can only be used to confirm our views based on the price itself. Coming from the world of currencies, I was heavily invested in charts and technical analysis, since macroeconomic factors were only useful for longer-term views. Active trading required reading the charts. I learned early that to have a view on currencies, you had to have a view on other markets. Interest rates and commodities were most frequently the external factors that affected a currency. And in order to understand those markets with a single analysis method, charting was the only way. You simply couldn't apply fundamental analysis of commodities to interest rates. And that's when I knew charts was my way to navigate the markets, and it stands at the core of my work over the past 15 years as a market strategist. One of the things that I've learned as a market strategist is that almost every trader has their own personal preferences. Some traders have longer-term views, others very short-term. It's almost impossible to use fundamental analysis for clients of different time horizons. Technical analysis, on the other hand, is extremely flexible, and the same charting techniques can be applied to a daily chart or a 5-minute chart. Regardless of how long or short your time horizon is, you can learn the same analysis method. This makes technical analysis not only adaptable for different clients, but allows you to see if the short-term view aligns with the longer-term view. This ability to analyze the markets on multiple time frames is at the core of my work for finding higher probability trades. If you have a bullish short-term and a bullish long-term view, you're more likely to have a higher probability of success on a bullish trade. No other form of analysis provides this edge. In my opinion, any asset with a price can be analyzed using technical analysis. This puts every futures product on almost every exchange as a suitable product for using technical analysis. However, there are some assets that are mean reverting, such as volatility, interest rates, and currencies, that can additionally benefit from statistical analysis to better time a trade. Using statistical analysis, we can identify extreme moves and fade those moves back to the average. However, it's important to understand that this strategy works only with certain asset classes that are mean reverting. This is by far the most common question that I receive as a market strategist. Investors want to know which indicators are best or which indicators that I use in my trading. And what I can tell you is that after working with thousands of traders in my career, successful traders are not successful because they use a specific set of indicators. They're successful because they are consistent in using the same ones each day, and they have mastered a single set of indicators. You do not need to have a proprietary or large number of indicators to navigate the markets, but you have to understand the one you use and be consistent with them. I personally use a combination of a 21 and 55-day exponential moving average to confirm a trend and a double CCI indicator to measure momentum at the core of my analysis. My most important piece of advice for those of you who want to leverage technical analysis for trading is that the specific indicators you use are far less important to your success of profitability than your risk management and discipline of applying them. With futures, you have access to leverage, which means that you can get yourself into trouble if risk is not managed properly. In my 15 years of working as a market strategist, there are a few rules that I see as critical to trading success with technical analysis. While following these rules will not guarantee you success, I can almost guarantee that if you do not follow these rules, you will almost certainly see significant losses. Keep the number of technical analysis indicators on your charts to just a few. Make sure you understand how they interact with each other and stick to the same indicators each day. Use price action to help you set stop loss and take profit levels before you enter each trade. And never risk more than 2% of your total account value on any single trade. That means if your trade is stopped out, it should result in a loss that is no greater than 2% of your total account value. And lastly, never double down on a losing position by adding more contracts to it, hoping that you'll get yourself back to break even. At this point, I want to take a pause and introduce the small exchange. Their ethos for designing futures contracts that are small, standard, and simple provide the ideal futures products for retail traders with smaller accounts. Compared to the full-size futures contracts, the small exchange futures products provide investors with the flexibility to scale in and out of a position while maintaining the 2% rule. With the full futures contracts that can have contract sizes that span tens or hundreds of thousands of dollars, even the most well-capitalized accounts sometimes find it impossible to stay within that 2% rule. When using technical analysis to determine entry and exit points, there are often entry ranges or zones, not exact levels. With contracts that are smaller, you can scale in and out of a position to prevent an all or none position. This allows for taking profits while maintaining a smaller position to continue to run, or stop out only half of a position and still have half a position for a chance to being profitable. This option is only available for contract sizes that are small enough to provide this flexibility. If you're interested in learning more about how you can navigate the markets with technical analysis, please watch my full webinar that I've linked below. To get started on trading small exchange futures products, you can open an account with either Tastyworks or IBKR or several futures brokers that I will link below. But make sure that you enable your futures account when you open a Tasty or IBKR account, which I will include instructions in the description below. I really hope that this video provides you with an overview of how technical analysis can be a powerful tool for trading futures. And if you're considering trading futures, that this video inspires you to learn more about how technical analysis can help you navigate the markets. And if you currently use technical analysis for trading, please let me know what your experience has been and any questions you might have in the comments section below. I am hosting monthly education on futures trading in 2022, and I look forward to seeing you at the next event. please register using the link in the description below. And I'd just like to say a huge thank you for watching this video. And please hit subscribe and make sure you click on the notification bell to get a notification of the next video in this series. And with that, I hope that you have a great trading day.